Hello and welcome back to The Note. We hear from Janet Yellen and the Fed later this week, and this is one meeting which isn't producing a great deal of controversy. People on the market think they know what we're going to hear this week. However, in the medium term, there is great concern and great debate over where the Fed is going. When exactly is it going to start tightening rates, and when is it going to start reducing its currently enormous balance sheet? With me now to discuss these very important questions is the Head of Global Asset Allocation for Société Générale, Alain Bokobza. Thank you very much for joining me today.
Thank you, John.
Let's start by taking a look at a chart you prepared on the unemployment picture in the US, and we see a relatively sharp improvement in the unemployment rate at this moment, which isn't being accompanied by the rise in real wages that one would normally expect. What do you think is happening here?
I think that is going to be one of the game changers in the forthcoming period for the Fed. You had a huge long period of falling unemployment and subnormative growth. Yes, since Lehman Brothers broke down, right. Growth in the US was positive but subnormative, very low. And wages have been very subdued too. We cannot imagine in the period to come, especially in the core scenario we have that the US economy switched back to 3% GDP growth for the next 2 or 3 years, that wage growth can remain subdued.
Okay, so does this suggest, if we take a look at another chart that you provided, does this suggest that the Fed is behind the curve? Normally, as you show here, once the unemployment rate has improved to this extent, you would have expected tightening already to be well underway. If
we had normal conditions, the Fed should already have started to hike interest rates. They would have done it in history. This time, you have an over-leveraged situation. You have also the difficulty for the financial sector. So the Fed has indicated they want to remain very cool in the normalization of the monetary policy. So they will stay behind the curve in the period to come. However, this does not mean that they will forever stay zero rate.
Okay, so they know they are deliberately behind the curve. Now, let's put this together, and this is a fascinating piece of research that you've done with the volatility picture. Now, the VIX is a relatively recent construction, but you have calculated it going back to the 30s. Take us through what we're seeing here. As far as I can understand it, the Fed funds rate really does drive volatility over the years.
Indeed. So, as you mentioned, John, what we do here is to reconstruct the VIX. The VIX is option pricing, so it's in the volatility of the equity market over time. And normally you can't go back prior to 1985 or so. So we have reconstructed with our capability in the US to do it. And we see that currently somewhere around 10-12% is a low. We have rarely gone under in long-term history. So we are living an ultra-low volatility regime, which is an indication that asset managers can take risk on their portfolios.
Okay, now what would change that? The Fed presumably could trigger a rise in volatility by raising Fed funds rate. Does it have any ability not to trigger rising volatility once it inevitably starts tightening?
So 2 questions in one.
Yes.
On one side, we bring on this graph the idea that whenever the Fed starts a new process to hike interest rate, to raise interest rate, this systematically triggered in history a rise in the volatility regime from a low regime to at least a normalized, if not a high regime. However, we might think on the new norm that not only you have the conventional monetary policy, which is the rate policy, but also the unconventional policy, what we nickname the quantitative easing, and the fact that the balance sheet of the Fed has quadrupled since Lehman Brothers failed. Remember, we were 1,000 billion, currently we are more than 4,000 billion. So the new question should also be, what will this balance sheet be in 1 or 2 years' time after the Fed starts hiking interest rate? If they maintain, as we think, the size of the balance sheet as big as 4,000 billion for some time, by the end of 2016, for example, it will be less of a tightening impact on the volatility than usual.
Okay, Alain, thank you very much indeed. Just to complete that train of logic, if we can keep the balance sheet where it is, that means we can keep volatility where it is for a while longer. That implies that there is the possibility for true exuberance in the US stock market before this bull market ends.